Most people who trade options lose money, and almost all of them are doing the same thing. They're buying options, hoping for a big move, watching their contracts slowly bleed out to zero. I used to do that too. I'd buy calls on stocks I was bullish on. I'd buy puts when I thought the market was going to drop. And I'd watch them expire worthless more often than not, wondering what I was doing wrong. Then I flipped to the other side of the trade, and everything changed. Today, I'm going to break down exactly why selling options puts the math firmly in your favor, covering probability, time decay, implied volatility, how to manage risk, and the specific setups I use. By the end of this video, you're going to see options in a completely different way. Let's start with why buying options is such a hard game to win. When you buy an option, you need 3 things to go right simultaneously. Number 1, the stock needs to move in the right direction. Number 2, it needs to move far enough to cover the premium you paid. Number 3, it needs to do all of that before the contract expires. That's a lot of conditions. And if even one of them fails, you lose. Sometimes, everything. Think about the guy who buys a call option on a stock expecting it to run up. The stock moves up 3%. Sounds good, right? But if the implied move priced into that option was 5% and the stock only moved 3%, the option might actually lose value, even though the stock went the right direction. That's the trap buyers fall into constantly. Studies consistently show that roughly 80% of options held to expiration expire worthless. That means if you're buying options and holding to expiry, you're starting with about a 20% chance of winning. That's not trading. That's gambling with extra steps. Now, flip it around. If 80% of options expire worthless, what does that mean for the person on the other side? The person selling them. They're collecting premium on trades that have roughly an 80% chance of working out. That's a completely different game. When I sell an option, I don't need the stock to do anything dramatic. I just need it to not do something specific. I need it to stay away from my strike price by expiration. I'm not predicting a big move. I'm betting on what the stock won't do. And statistically, that's the winning side. This is the core insight. Buyers need to be right about direction, and magnitude, and timing. Sellers just need to be approximately right about one thing, that the stock won't make an extreme move. This brings me to one of the most important concepts in options trading, Theta. Theta is the rate at which an option loses value each day from time passing alone, assuming everything else stays the same. It's often called time decay. When you buy an option, Theta is your enemy. Every single day that passes, your contract loses a little more value. You're in a race against the clock. You need the stock to move, and move fast, before your option erodes to zero. When you sell an option, Theta is your best friend. That same erosion is working for you. You collected the premium up front, and now time itself is paying you. You literally get paid to wait. Here's where it gets even better. Theta doesn't decay in a straight line. It accelerates as expiration approaches. Options lose value faster in the last 30 days before expiration than they do in the first 30 days of their life. So if you're selling options with 2 to 4 weeks until expiration, you're catching Theta at its most powerful, the steepest part of the decay curve. Every day that passes is another win. Buyers are fighting time. Sellers are getting paid by time. That asymmetry alone is enough reason to switch sides. Now, not all options are worth selling at any time. This is where IV rank comes in, and this is a concept most retail traders have never heard of. IV stands for implied volatility. It's the market's expectation of future movement baked into the option price. High IV means options are expensive. Low IV means options are cheap. Think of it like this. When fear is high in the market, options premiums spike. People are buying insurance. Prices go up. And when things calm down, those premiums deflate. IV rank tells you where current implied volatility sits relative to its own range over the past year. An IV rank of 80 means volatility is higher right now than 80% of all days in the past 52 weeks. Why does this matter for sellers? Because when IV rank is high, you're collecting inflated premium that has a strong tendency to come back down. This is called mean reversion, and it's a powerful tailwind for option sellers. Here's how it plays out. You sell a high IV option and collect rich premium. Over the next few days or weeks, volatility contracts back toward normal. The option price drops, both from theta decay and from the IV compression. You buy it back for much less than you sold it for. That's your profit. My rule of thumb: I look for IV rank above 50 before selling premium. The higher the better. Below 50, the premium often isn't rich enough to justify the trade. At this point, you might be thinking, this sounds great, but what about the risk? Selling naked options sounds terrifying. And you're right to think about that. A naked short option, selling without a hedge, does carry significant risk. A short put on a stock that goes to zero. A short call on a stock that gets acquired and gaps up 50%. Those are real risks. That's why I use credit spreads instead of naked options for most of my trades. Here's how a credit spread works. Instead of just selling one option, you sell one option and simultaneously buy another option at a further out-of-the-money strike as a hedge. The premium you collect on the one you sold is more than the premium you pay for the one you bought. The difference is your credit, hence the name. Your max profit is the credit you collected up front. Your max loss is the width of the spread minus the credit received, and you know that number before you ever enter the trade. Let me give you a concrete example. A stock is trading at $100. I sell the $90 put and buy the $85 put with 30 days to expiration. I collect a net credit of $1.50. That's $150 per contract. My max profit, $150. The spread expires worthless. I keep everything. My max loss, $350. That's the $500 spread width minus the $150 credit. For that spread to hit max loss, the stock would need to fall below $85, a drop of more than 15% in 30 days. My probability of profit on a trade structured like that? Around 75 to 80%. Defined risk. High probability. Theta working for me every single day. That's the setup. One thing that separates consistent option sellers from people who blow up: knowing when to get out. My standard rules are simple. Take profit at 50% of max gain. If I collected $150 and the spread is now worth $75 to close, I close it. Don't be greedy. Take the win and redeploy the capital into a new trade. Over time, taking 50% of max gain on a high probability trade is mathematically superior to holding for the full premium. Cut losses at 2x the credit. If I collected $150 and the spread is now worth $300 to close, I close it and move on. It's a defined loss. It doesn't wreck the account. 3 or 4 wins cover that one loss. Never hold through earnings or major events. Earnings announcements are binary. They can gap a stock 10, 20, 30% overnight. Implied volatility before earnings is often so high that it looks tempting to sell into. But the risk isn't worth it until you're very experienced with managing those positions. People sometimes ask about assignment risk. What if the option gets exercised and someone puts the stock to you or calls it away? For credit spreads, assignment on the short leg is possible but manageable. If you're assigned on your short put, you can immediately exercise your long put to offset most of the exposure, or you can sell the stock if it gets put to you. The max loss is still capped at the spread width. The bigger lesson is this: assignment usually doesn't happen until expiration, unless the option is deeply in the money. If you're monitoring your trades and managing them before they get deep in the money, you'll rarely deal with assignment. And if you're only trading spreads, not naked options, your risk is always defined. I want to spend a minute on this because I see people skip it entirely, and it destroys them. No matter how good your strategy is, if you size your positions wrong, you will blow up your account. My rule: never risk more than 2 to 5% of total account value on any single trade. If you have a $10,000 account, that's $200 to $500 max loss per trade. With credit spreads, you know your max loss before you enter. You can calculate exactly how many contracts you can trade and stay within your risk limit. That's the beauty of defined risk trades. Trade small. Be consistent. Let the probabilities play out over dozens and hundreds of trades. That's how option sellers build real returns. Here's the mental model that changed everything for me. Stop thinking about options as lottery tickets. Start thinking about them the way an insurance company thinks. Insurance companies don't win every claim. Houses burn down. Cars get totaled. People get sick. But the insurance company prices their products correctly, collects premiums consistently, manages risk across thousands of policies, and over time, the math works in their favor. That's exactly what option selling is. You're the insurance company. You're getting paid to take on risk that's been priced at your advantage. Some trades will lose. That's fine. Over a large enough sample size, the edge is real and it compounds. Buyers are hoping for lightning to strike. Sellers are running the business. To be balanced, here are the situations where I don't sell options. Low volatility environments. When IV rank is below 30, premiums are thin. The risk-reward just isn't there. I wait. Highly speculative stocks or meme stocks. The probability models break down on stocks that can move 50% on a tweet. Stick to stable, liquid underlyings with real businesses, ahead of binary events you don't understand. If you don't have a view on an earnings report or a clinical trial, don't try to sell premium into it. And if the market is in a true panic, rapidly falling with spiking VX, be careful. High IV is tempting, but you can get run over if you sell before a bottom is actually in. Here's the bottom line. Selling options is not a get-rich-quick strategy. It's a get-paid-consistently strategy. It requires discipline, proper sizing, and patience. But the math is genuinely in your favor, in a way that buying options is not. If you want to get started, paper trade credit spreads for a month before using real money. Get comfortable with the mechanics. Learn how Theta and IV rank affect your P&L in real time. Then scale up slowly. The edge is real. The math is real. You just have to be on the right side of it. If this was helpful, subscribe. I put out videos on options trading, investing, and real personal finance strategies that actually work. No gurus, no hype, just the math. I'll see you in the next one.